Machine learning is supposed to transform quantitative investing. But a recent paper by AQR's Bryan Kelly and co-authors reveals a counterintuitive truth. Deep neural networks fail not because they can't find signals, but because they overfit portfolio weights. The industry expects machine learning to unlock hidden patterns in financial data. Yet, when applied to portfolio construction, deep neural networks often underperform simpler models. The paper identifies the root cause. It's not the feature discovery that fails, but the estimation of portfolio weights. In joint training, the model simultaneously learns optimal nonlinear features and optimal portfolio weights. With limited financial time series samples, the high degrees of freedom lead to severe overfitting in the weight estimation step. As a result, even if the features contain strong pricing signals, the noisy weights degrade the final portfolio's performance. Formally, we have a prediction function that maps features to expected returns, and we estimate it by minimizing a loss. The model has two components, a feature extractor and a linear portfolio weight map. During training, both are updated together. The problem is that the weight map has many parameters, as many as the number of assets, and with only t time periods, the effective sample size is small. The variance of the weight estimates can explode, leading to poor out-of-sample performance. The core issue is the bias-variance tradeoff. A complex model with many parameters can fit the training data very well, but it also has high variance. Small changes in the data can cause large changes in the estimates. In finance, the signal-to-noise ratio is low, so high variance is especially damaging. The model may capture true nonlinearities, but the noise in weight estimation swamps the signal. The paper's key insight is that these two tasks have different difficulty levels. Feature learning, identifying nonlinear interactions, can be done effectively with neural networks. Weight estimation, however, is a high-dimensional problem that requires many observations to pin down. In finance, we often have hundreds of assets but only a few years of daily data, making weight estimation extremely noisy. AQR's solution is the Portfolio Tangent Kernel, or PTK. The idea is to decouple feature learning from weight estimation. First, use a neural network to extract features. Then, instead of learning weights from the same network, apply a closed-form portfolio rule that is more robust. The PTK is a kernel matrix that captures the similarity between assets based on the learned features, and the optimal portfolio weights are derived analytically from this matrix, reducing the number of parameters to estimate. The paper's empirical results show that the PTK approach improves out-of-sample performance compared to standard neural network portfolios. While we don't have the exact numbers here, the concept is that by reducing the variance of weight estimates, the PTK achieves a higher Sharpe ratio, a measure of risk-adjusted return. This is a stark contrast to the common belief that more complex models always perform better. Akkadian Asset Management echoes this view. The true value of machine learning is in nonlinear prediction, capturing complex interactions between factors, not in replacing the entire investment process. Using LSTM or transformer models to directly predict next-day returns is prone to overfitting, and live performance often lags backtests. Instead, the practical role of ML is to synthesize hundreds of factors into a single predictive signal. In practice, many quant funds find that tree-based models like XGBoost and LightGBM are more reliable for factor synthesis. They handle nonlinearities well, are less prone to overfitting with proper regularization, and are easier to interpret. Deep learning, on the other hand, requires vast amounts of data and careful tuning, which are often unavailable in finance. So, what does a robust AI quant workflow look like? Instead of using deep learning to predict prices directly, you start with a large set of fundamental, technical, and alternative factors. Then, apply XGBoost or LightGBM to combine these factors into a composite score. This score can be used for stock selection or portfolio weighting. The key is to validate rigorously with walk-forward analysis and to keep the model as simple as possible while capturing the necessary nonlinearities. Let's summarize the key points. First, deep learning's failure is due to weight overfitting, not feature discovery. Second, the portfolio tangent kernel decouples these tasks and improves performance. Third, tree-based models are often more practical for factor synthesis. Fourth, always validate out of sample. And fifth, Complexity is not a virtue in quant finance. In the end, the lesson is clear: machine learning in quant finance is not about using the most powerful model, but about using the right tool for the right task. Feature learning can be complex, but weight estimation must be robust. The portfolio tangent kernel offers a principled way to achieve that. And for many practical applications, tree-based models are the workhorses. Your feedback helps us refine our research. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.